Good afternoon to the Board of Directors of Standard Plank Bank. My name is Zatia Asmal, and I am one of the financial and risk consultants hired by you guys to give an overview of the fall of Credit Suisse. More importantly, I'm here to give you guys recommendations on how you can avoid the same kind of outcome as Credit Suisse. So in order to do that, we're going to look at the reasons why the bank failed, looking at how loss of investor confidence, loss of investor trust led to the fall of the 167-year-old giant in Swiss banking. So let's start off by talking about, in general, right? Why do banks fail? So there's two major reasons why a bank would fail, right? You've got a miscalculation of risk, or you've got liquidity issues, right? So looking at Credit Suisse at itself, right? They had a positive liquidity coverage ratio, meaning that liquidity is not their issue. They had more than enough funds to pay back in the event of a bank run, right? Unlike SVB, as we all know. However, looking at the miscalculation of risk, this too wasn't a very good culprit for their issues, given that they survived the financial crisis of 2008 relatively unscathed, meaning that their risk mitigation in terms of quantitative risk was more than okay. Right? So if it wasn't a miscalculation of risk, if it wasn't liquidity issues, what led to the fall of this bank, right? So ultimately, the bank's plummeting share price concerned investors given the bank status as a globally systemically important bank, which led to its merger with UBS, obviously the whole too big to fail scandal, the whole big to fail concept, right? Now, the continued weakening of the share price can be described as a series of self-inflicted wounds because of the bank's numerous scandals, ranging from espionage, money laundering, tax evasion, and other stuff like that. But the underlying cause of this dwindling share price reflects a complete loss of trust and confidence in Credit Suisse on behalf of investors. Now, while continued deposit withdrawals and the cease of investment from Saudi National Bank served as the final nails in the coffin for the Swiss giant, it was the bank's reckless risk appetite, lack of consistent leadership, and inefficient risk management practices which caused investors to both lose trust and confidence in the bank. So looking at this kind of vicious cycle almost of Credit Suisse, right? You start off with this very toxic work culture, right? Promoting profits, profits above all else. When you want profits above all else, what do? You take more risks, right? Taking more risks in the form of riskier investments, maybe not being as transparent with your investors because obviously there are risks with your investments, right? Leading to, as we said, unethical business practices. Such practices leads to scandals, right? Which, as we know in Credit Suisse, they had numerous scandals, as we will see. But in this discussion, we'll talk about the Archegos scandal, the espionage scandal, and the tuna bond scandal, right? Obviously, when a scandal happens, share prices plummet. How do we interpret share prices plummeting? As a loss of investor confidence, right? After investor confidence dwindles, management says, you know what, we're going to take a step back, reshuffle our cabinet, so to speak, with a leadership change. But then as time goes on, we see senior management still cares about the toxic work culture. They still care about the profits, right? This is like the vicious cycle that we see with Credit Suisse that kind of acts as a premonition for their downfall, essentially. So let's talk about how Credit Suisse essentially lost their investor trust. Then we'll move on to how they lost investor confidence. And thereafter, we'll come back with the recommendations as to how your bank, SVB, can mitigate the risks that unfortunately Credit Suisse could not, right? So number one, right? How did Credit Suisse lose their investor trust? So looking at the first case study, which is their espionage scandal, right? The former CEO, Antonio Horto Osorio, claimed that the situation at CS during his 9-month tenure was worse than anything he had ever seen, with scandals permeating even the most senior levels of management, right? Now, CS culture is one of the most voracious risk-taking and flagrant disregard for ethical business practices that I think anyone in the recent banking history has seen, right? Now, the espionage scandal, which involved the former CEO, TM, in which a corporate espionage company was hired to essentially spy on the former head of wealth management, Iqbal Khan, represents a senior management's disregard for ethical business practices, and it paints a very jarring portrait of ethical standards that are present for the rest of the bank. right? Obviously, following the publication of the scandal, the CEO was forced to step down and the share price essentially plummets, right? As we can see over here, spy scandal, CEO resigns, share price all the way down, right? Now, what this represents on a larger scale, the insights from this is that the culture within Credit Suisse, this risk taking, this disregard for ethics, right? It permeates even the most senior level management. It's one thing if independent traders are doing things like this. I mean, even at SVB, for example, you can't control every single person. There are going to be a few bad apples, so to speak. But when the bad apple is your CEO, what picture does that paint for investors? What does that say about the company as a whole? And I think looking at the share price plummeting tells you all you need to know, right? When a company does something like this, when their figurehead rather does something like this, it paints a picture of we don't really care about ethics. We are here for the profits. And as investors, we think to ourselves, well, how can I trust a company like this? How can I'm putting my money into you, but I can't trust you. So as we can see over here through this case study, right, Credit Suisse did not really care about their ethics, even at the most senior level of management, right? And looking at another case study, which we can see over here, Mozambique and fine, right? This is regards to the tuna bond scandal, right? So between the years of 2013 and 2014, Credit Suisse, in collaboration with VTB Capital, loaned upwards of $1 billion to three state-owned enterprises in Mozambique, with the intention that these funds obviously be used for maritime projects and for tuna fishing in the region, right? Now, these funds were very, very poorly managed, with large sums being embezzled by both African politicians and CS traders alike. Now, here's where it gets a bit sticky, right? The bank was fully aware of the discrepancies between the funds raised, right, and the value of the boats purchased, which obviously indicates fraudulent activity, right? However, they failed to disclose this information to the investors, right? Additionally, Credit Suisse failed to maintain transparency with the investors, and they did not inform the investors to the extent of Mozambique's debt, right? Essentially, you're not being honest with your investors, which is a big no-no, as we know in the finance world. Now, in this case, as I said, CS knew full well of the risks regarding this deal, but failed to inform investors, which once again represents their clear disregard for ethical business practices, as well as a disregard for their shareholders' interests, right? Obviously, in the wake of the scandal, Credit Suisse was ordered to pay fines of about 500 million US dollars and agreed additionally to forgive $200 million of Mozambique's sovereign debt, right? Naturally, in the wake of the scandal, as we can see over here, your share price plummets. I think what these two case studies really illustrate to us is how important ethical business practices are to investors, right? Why is that? Trust. Trust above all else. Because as an investor, I am giving you my money with the intention that you will use it wisely, that I want a positive return on my investment. But when you do things like abuse my trust, when you commit corporate espionage, when you make shady deals, right? That points to you being untrustworthy. And as an investor, I don't want to put my money in untrustworthy hands, hence why the share price plummets. And as we can see, just generally looking at this timeline, right, the share price continues to plummet over and over and over again. Now that we've discussed how Credit Suisse lost investor trust, let's look at how Credit Suisse essentially lost investor confidence, right? So our third case study, we'll be talking about the Archegos scandal, right? Archegos scandal is essentially over here in March 2021. Now, in the wake of the collapse of the family office Archegos, Credit Suisse did incur a loss of over 5 billion US dollars. However, they weren't the only bank involved in the scandal, in the losses, right? Your Goldman Sachs, your Morgan Stanley, right? All had losses. However, none had the amount of losses that Archegos maintained. That Credit Suisse maintained in the wake of Archegos, right? However, they suffered the most because of their poor risk management practices, right? Now, in their official report that followed the scandal, the bank had fully admitted that they had ample information well before the events of the week of March 2022, 2021, right? The report went on to further claim that senior management quote, lacked the competence to appreciate the risk significance, right? Which indicates to us that the bank either did not care about the risks or didn't understand them. Now, either of those cases doesn't point to very high competence within the bank, right? If you don't understand what a risk is, if you choose to ignore the risk, right? I have no confidence in you. I have zero confidence in your ability going forward in the long term, right? Now, take it one step further, the credit risk management team within Credit Suisse advocated for an increased risk appetite, right? Out of fear that any drawback on spending limits might lead to Archegos moving its business to its other prime brokers. Now, what this indicates is that Credit Suisse, once again, right, coming back to this idea of a toxic work culture promoting profit above all else, right, they didn't care about the risks. They didn't care that Archegos is bleeding capital, bleeding money, right? All they see is we can make a huge profit. And yes, for 2 days, they made a huge profit. But as we know, when Archegos defaulted on its risks, a $5 billion loss was coming down to Credit Suisse, right? Now, the Archegos scandal in summation, I think it perfectly encapsulates everything that was wrong with CS's business model. I think at its core, it's just an ignorance for risk, despite the many red flags being raised, right? Credit Suisse is fully aware of what's going on, but once again, they choose to ignore it, right? So now that we've kind of painted the picture of why Credit Suisse fell, right? Loss of investor confidence, loss of investor trust, it's time to move forward and look at where does SPB fall into this, right? You are our client, that's my job, right? So here are some recommendations that I have for Standard Plank Bank, right? So just once again to put everything into context, right? So following the Archegos scandal, CS released their response to the Paul Weiss report. As we can see over here, some notable quotes, right? In their first line of defense, they're appointing an ad interim head of equity. Second line of defense, new risk management for prime services risk, right? And interestingly, over here, we can see that there's a very big kind of onus on this idea of individual accountability, right? Fostering a culture of individual accountability, right? So, as we can see from this, what can we take away from Credit Suisse, right? These policies that they gave out after the Archegos scandal were essentially useless because right after Archegos, after these policies were implemented, we had Greensill, right? So essentially, these policies are useless. Nothing here worked, right? But why didn't it work? I think the reason why is because it focused on a superficial, surface level approach to risk management, which focused on bureaucratic based solutions and a focus on individual accountability instead of encouraging a culture of collective responsibility and a complete overhaul of the bank's voracious risk appetite, right? So, following all of this, where do we fit in, right? What's the potential next steps? What's our recommendations for the bank, right? For your bank, right? So I've got two major recommendations, right? So Credit Suisse was marked by unethical business practices, and any recommendation into avoiding a fate like this obviously says, don't do what Credit Suisse does. But obviously saying don't commit fraud, right? It's not a good enough response. We all know that. We've all gone through many ethics boards, right? Don't commit fraud is not enough of a recommendation, right? What your bank needs to do is focus on this collective culture, collective responsibility. Because as a bank, you need to be united. You can't just say, oh, well, any fraud case we had was the action of a few bad traders. No, that's exactly what Credit Suisse did. But what happened? They crashed, right? You need to maintain this united front, this collective responsibility, right? And the two main ways that we can see you guys doing this practically, number one, it's financial incentives for good practice, right? Punishing someone for doing something bad, it hasn't worked, right? Taking away money, taking away titles, right? It still doesn't solve the problem. However, providing financial incentives for good practice, it's kind of a paradigm shift, but it's a good solution, one that no one else has tried before, and we're very optimistic to see how it would work in Standard Plank Bank. And then our second recommendation or potential next step for your bank is a facilitation of easier communication, of easier communication channels for risk escalation, right? So looking at Credit Suisse, right, once again, they were fully aware of the risks involved with Archegos, with Greensill, with the tuna bonds, right? Everyone knew about the risks, but the right people were not getting the correct information. There was not a well understood grasp of the risks. And that's where we believe that you guys need to be very on top of things, right? As we know, we can't predict the future. I can't predict the future. You can't predict the future. However, we can manage the risks. If we know something, we should say something and we should speak up. After all, it takes many good deeds to build a good reputation and only one bad one to lose it.